In my last couple of videos, we talked about verifying income and how lenders look at W-2 employees. Today, let's talk about something completely different: self-employment income. If you're self-employed, this is extremely important to understand. You might tell me, Ronnie, my business makes $500,000 a year. Okay, but that doesn't necessarily mean we have $500,000 of income to qualify you for a mortgage. There's a big difference between your business revenue and your qualifying income. So how do we determine your income? For a traditional mortgage, one of the first places we look at is your tax returns. Depending on how your business is structured, we look at your personal tax returns, your 1040s, business tax returns, K1s, Schedule C, or other documents. And we're not simply looking at your gross business revenue. We need to determine the income that you actually be used to qualify. And this is where it gets complicated and interesting. There may be certain expenses on your tax returns that we can potentially add back when calculating qualifying income. For example, depending on the situation and the loan guidelines, certain non-cash expenses such as depreciation may be added back. But it can also work the other way. There may be other expenses or deductions elsewhere in the tax returns that we need to consider, and those may actually reduce your qualifying income. So we don't simply look at one number and say that's your income. There's a calculation involved. We also look at the entire history trend of the business. Is the income stable, increasing, consistent, or declining? Because the history and likelihood that the income will continue are important. Now, what if you're self-employed, but you don't want to qualify using your traditional tax returns? There may be other options. For example, we may have a bank statement program where qualifying income can be determined using your eligible deposits. There are also programs where a profit and loss statement or P&L may be used to help determine qualifying income. These programs have their own requirements. So if you're self-employed, don't automatically assume my tax returns don't show enough income, so I can't qualify. And don't assume my business has high revenue, so I definitely qualify. Neither one gives us the complete answer. We need to understand your business, your income, how it's documented, and which mortgage program we're using. That's how we determine your actual income. And in the next video, we'll move to another major part of the mortgage qualification, your credit.